One of the big areas of focus for, well, since the start of this year, long before the start of the year perhaps, as well, has been the metals rally. We've seen new highs this year in gold, in silver, in tin, in copper. The list just grows and grows. Seems to be risk on and risk off reasons to be buying metals right now.
I think that's absolutely right. Probably the biggest driver is the attack on the Fed, or at least the most recent big driver. I shouldn't say it's the fundamental driver of the whole move, but the latest attack on the Fed, it continues to get people worried about the idea of Fed independence, the idea that monetary policy will be pressured to be easier than orthodox economics would suggest. That is fueling into this idea to buy precious metals. I wouldn't want to say this is a debasement trade, which is a kind of term we threw about last year, because we're not seeing many other meme stocks, go crazy again. But there's certainly a hint of that in the last 24 hours. We're starting to see crypto do better again. We're starting to see some of the frothier names get a little bit of a bounce again. So maybe if that sustains, we'll start bandying around the term debasement again. But I think this is more about the idea that there's a general industrial demand for some of those metals because of the fiscal stimulus that's been pumped in around the world, and China's economy is still doing okay on that kind of front. Obviously, fiscal stimulus coming through in Germany, in the US, in Japan, etc. And then we also have the attack on the Fed and an expectation the dollar will weaken this year, which is driving precious metals.
Did the Chinese not want their stock market to go up?
I think they want a sustainable rally. I think it's going to be a hard one to get. We've talked a lot on this show, Guy. As you know, myself and most of my team were kind of structural bulls on the China market, or more so the Hong Kong stock market, but that's just a derivative play. We think that's the better play on the China story, but we think it can outperform US stocks for kind of a long term and years to come. I think one of the issues they have in China is they're trying to get out of this boom bust cycle. This is what we saw in Chinese market before. We saw 2007, a big boom, massive crash. Then we saw the 2015 boom, massive crash. They're trying to get a more sustainable bull market. I think they're going to struggle to. I think it's going to be hard with the blow up of the residential market. Now that 16 months ago the Chinese government made clear they're going to sustainably prop up the equity market, and that message was very, very clear and has been correct. People are now starting to get excited that equities is the next boom market, so they're just trying to slow down that bull market.
Mark, on the equities in the same region, 1.5%, another solid day for the Nikkei over Japan. What's the cleanest trade on Japan elections at this point?
It's a great question. To me, look, as you know, Tom, I've been a structural yen bear for years, and I still think that's a trade that's going to keep on working for a long time to come. This is an economy that is permanently stagnant with deeply negative real yields. They can't afford positive real yields, so you're never going to get paid to own the yen because they've got too big a debt pile, and now they're exploding the debt pile. And in fact, there's technical dynamics as well because people buy the Nikkei FX hedged, and as the Nikkei goes higher, they hedge further and they continue to drive that trade and gets a bit of momentum. That said, I'm not sure dollar yen is necessarily the way to play it. I'm bearish the dollar for 2026. So I think short yen and cross is probably the most sustainable way to play it. But I think all three elements do work. Long stocks, short JGBs and short yen.